Hey y'all, what's going on? It's Professor Barth here, history professor at Arizona State University. So of course, earlier today, the Federal Reserve, more specifically the FOMC, the Federal Open Market Committee, made an important announcement that they will begin a process of tapering. Now, what the heck does tapering mean? We're going to take a look at that in this video. But there's a false belief out there that the Fed has announced that they will begin tightening the money supply, that they are now pursuing a policy of tightening, and that is not true. That's not the case. On the contrary, as we will see in this video, the Fed has announced that they will continue this policy of monetary expansion, of growth in the money supply. That continues. The only thing that's changed is that the rate of expansion will decline every month by a little bit, but it's still growing. We still have an expansionary monetary policy. Taper still means more paper. The Fed is still creating billions and billions and billions and billions of new currency units, dollars, out of thin air every single month for asset purchases. And interest rates remain near zero with no sign of any meaningful rate increase in the near future. So inflation is at a 30-year high. The CPI increased by 5.4% in September. The CPI has been over 5% since the spring. What's the Federal Reserve going to do? Milton Friedman once said famously that inflation is always and everywhere a monetary phenomenon. The Federal Reserve is in charge of our monetary policy. And so all eyes were on the Fed in advance of this meeting. Now, since the pandemic, the Federal Reserve has had a policy of purchasing $120 billion a month, every single month, $120 billion in bonds, treasury bonds, and mortgage-backed securities, but mostly treasuries. $120 billion every month. Now, where do they get that $120 billion? They create it, okay? They create they're in charge of creating new currency units. They don't even print it, really. I mean, small amounts are printed. It's mostly digitally created, zeros added to bank accounts, created out of thin air in order to purchase these assets. It says quantitative easing. It says it's distinct from the interest rate, which we'll see in a moment. But this is this is the Fed's balance sheet. Look at what has happened since the pandemic. Before the 2008 crisis, the Fed's had about $1 trillion of assets. Then 2008 happened. Fed's balance sheet doubled. But look at what has happened since March of 2020. Since March of 2020, the Fed's balance sheet has grown, or has almost doubled. Has grown by more than $4 trillion. More than $4 trillion, and now stands at $8.5 trillion. What have they done? Again, quantitative easing, these asset purchases, and they've paid for those assets by creating new money. And so you look at M2, the most common measure of the money supply. Look at the growth in the money supply. This is dating back to the year 2000. But you see here, 2020, look at that huge increase in the money supply. They're creating new money, new currency, in order to buy these assets. And so that's what's at stake. So what was the announcement? Today, the FOMC announced that they will begin to taper. And by taper, that does not mean they're going to end these asset purchases, this bond buying program. They're not ending it. They're continuing it. Later this month, the Fed announced that they will purchase $105 billion worth of bonds and mortgage-backed securities. In December, it will be $90 billion. And the intention here is to reduce it by $15 billion every month. And the Fed's allow for some flexibility there. The expectation is that tapering will conclude by July, so this quantitative easing program should conclude in the summer. But between now and the summer, every month, tens of billions of dollars of new dollars will the Fed will inject into the economy to purchase these assets. But the reduction is $15 billion every month. So, put differently, this graph will continue to rise. Every month, this will continue to go up, the Fed's balance sheet. M2 will continue to go up. So there's no tightening here. This is not tightening. Each of these graphs will continue to, these lines will continue to rise in the upcoming months. Just the rate of expansion will be a little less each and every month. And the wiggle room that the FOMC has given itself, it said in their statement, the committee judges at similar reductions. So they announced officially late November $105 billion in purchases. In December, $90 billion of new purchases. And they expect $15 billion every month. They judge at similar reductions in the pace of net asset purchases will likely be appropriate each month, but the Fed is prepared to adjust the pace of purchases if warranted by changes in the economic outlook. What does that mean? Well, if inflation gets worse, if the numbers in early 2022 are if the inflation rate's a lot higher than the Fed anticipated, then the reductions might be more than $15 billion every month. Or maybe they'll just have to, if it's bad enough, they may have to end it entirely quicker than they anticipated before the summer. Alternatively, maybe if inflation, and I don't see how this happens, but just as a hypothetical, if inflation were to, if the inflation data were to be, if inflation were to be less than anticipated, then maybe they wouldn't reduce their asset purchases in the subsequent month. They say, oh, okay, we're safe. We can still make these purchases every month. That's not going to happen. But so they've left themselves room to increase the reduction, but they're intending on $15 billion less every month. Now, they had this to say, and this is just wild. I mean, you expected it. You expected them to say this, but still. They said on inflation is elevated. Yes, it's elevated. Inflation is elevated, largely reflecting factors that are expected to be transitory. So they're still sticking to this word. They love this word transitory. Some people were predicting they're not going to use the word transitory because it makes the Fed look bad. They've been saying inflation is transitory since May and June. They've used that word, but here they go again. Transitory. It's transitory. The only thing they did different here in their statement, they added this qualifier, expected to be transitory. So I guess that qualifier, is supposed to mean something. But inflation is elevated, largely reflecting factors that are expected to be transitory. Supply and demand imbalances related to the pandemic and the reopening of the economy have contributed to sizable price increases in some sectors. So what do we have here? The Fed is still refusing to acknowledge that their policies are contributing to the inflation. That's the short end of it. The Fed will not acknowledge that its bad policies are contributing to these price increases. They can't do it. They have to do this game of blame shifting. Jerome Powell said in a separate statement today, our baseline expectation is that supply chain bottlenecks and shortages will persist well into next year and if elevated inflation as well. So he says you can expect elevated inflation into the next year. Why? Not because of Fed policy, but because of supply chain bottlenecks and labor shortages. Nevertheless, he said, as those problems ease in the supply chain, quote, inflation will decline from today's elevated level. So he's sticking to this narrative. He's all in on this idea that the Fed is not responsible for this inflation. The Fed has not contributed to this inflation, and that inflation will be under control by this time next year. He's committed to that narrative. On the interest rate, interest rates are near zero. Finally, beginning in 2016 into 2018 and 2019, the Fed was raising rates, much needed, increase in the federal funds rate. And then in March of 2020, the bottom fell out and we're back to near zero. To give you an idea, this is the historic chart of the federal funds rate. So rates are near zero right now. You're going to have to do something about this. Now this is separate from the quantitative easing, the federal funds rate. This is the rate at which banks within the Federal Reserve System lend to one another overnight. And it influences the prime rate. It influences the entire economy. Watch one of my past videos on the Federal Reserve if that's something that interests you and learning more about. But on the federal funds rate, Powell said this today: we don't think it's time yet to raise interest rates. There's still ground to cover, and by ground to cover, he means in healing the economy. Market analysts today predict that we'll probably see 2 or 3 rate hikes next year, but that we probably are not going to see a rate hike until the tapering program is done and quantitative easing is over. So summer of 2022. So for the next 9 months, we'll still have easy money, near zero interest rates, plus quantitative easing, expansion in the money supply, in the midst of inflation that is at 30-year highs, and by this upcoming spring might be worse. So why is the inflation happening? I made a long video on this last week. I suggest you watch that. But I mean, come on, this is quite obvious. The Fed's balance sheet has more than doubled. The money supply, look at those figures. The M2 in February 2020 was 15 trillion. M2 today is 21 trillion. The money supply, in short, has increased by 38% in the last year and a half. 38% increase in the money supply in the last year and a half. You mean to tell me that this growth in the money supply, 38% growth, has nothing to do with the increase in prices? I mean, it's pretty incredible that again, it's all blame shifting. The Fed cannot admit that they are contributing to this growing crisis in dollar confidence. And you look at the historic charts, and there is a strong correlation between M2, which is in the black, and the CPI, which is in the red. Okay? This 38% increase that we have seen since February of 2020 in the money supply, that is going to lead to increased prices.